Alrighty. Welcome everyone to another Forex FX Street webinar. My name is Fan Yang. I'm your chief currency analyst at forexminute.com. And today I just want to take a look at some of the major currency pairs, their technical developments, their fundamental factors that's affecting them, driving these moves. And, if we can plan a few trades here and there, that would be great. But they might not always be, imminent. Now, as far as the euro dollar, if this webinar was maybe a couple hours earlier, we would be catching this right here. This trade setup at 1.25. It's a little bit hindsight at the moment, but I think we can still talk about the concept here in terms of trading, setting up this trade, even though it's a few hours into it already. Now, heading into the week, at the start of the week, we had a rebound from last week's low, which was also the low on the year. Now, this was a very important move last week because when we let's look at the 4-hour chart. Because last week we broke below a month-long consolidation in the euro dollar. Okay, the euro dollar's been, it was trading sideways. Although it maintained somewhat a bearish bias, it did trade sideways, and until it was after the FOMC announced the end of QE, and after last week, the ECB appeared to be gearing up for QE. After these two central bank events, we should still be bearish on the euro dollar because in terms of fundamentals, the monetary policy direction is diverging, right? We have the FOMC getting ready to raise rates mid 2015. It really depends on how this end of the year comes out. If we have growth, if we have strong wage growth, that's going to be an important theme because even though we got job growth, we don't really have the wage growth now that would be the next consideration factor for the FOMC. In any case, the general theme is that we have diverging central bank policy directions. The euro dollar should be bearish. We see this breakout into new lows, and now we're seeing lower highs and lower lows, right? So when we started the week with price going up to 1.25, it was approaching this previous high here at 1.2533, and for me, a break, we could put a stop right above 1.2533, as a trade setup to trade into the direction of the trend, to trade a correction. So the correction came up to 1.25. If you read my article on Forex Minute, we talked about 1.2490 being probably a more realistic entry after the market retreated from 1.25. In any case, if our stop is above 1.2533, let's say 1.2545 or 40, then we pretty much have about a 50 pip risk. Okay, maybe a little more. Let's say 50 to 60 pip risk. Okay. Now from 1.2490, our target would be down here. Let's be conservative and call it 1.2380 or even 75 instead of the 1.2357 low. Okay. Let's say 1.2370. So that's 120 pips of potential reward without breaking into new lows. So you can see this is somewhat of a conservative target, considering that we have a bearish trend that's intact. So 120 to 50, a little better than 2 to 1. This was an appropriate short-term trade, and it's working out so far. Now, when it gets to 1.24, I would suggest moving the stop to lock in some profit in case the market turns up from 1.24 for another correction swing. Okay. Now, if there is another correction swing, if the current bearish attempt does not extend lower is not another bearish leg, and instead is just kind of a part of a consolidation, then we have upside towards the 1.26 level. Now, if the market breaks above 1.2533, this previous high here, which would reflect sort of a shift in trend in the short term. The medium term is still bearish. So if the short term trend, if we have some upside risk in the short term, we should look at this 1.26 25, really 1.26 to 1.2650 area as a area to sell. Now we have a falling trend line, we have the moving averages, we have the previous support resistance pivot. Let me actually add this here. Okay, so around 1.2625, that might be an ideal entry. Okay, let's say we get in lower than that. Let's say like 1.26 area, 1.2610 would be still pretty good. So let's say 1.26. Okay, assuming we're gonna see some reaction first. We're not just gonna sell as soon as if price is surging towards 1.2625. We want to at least see a little bit of reaction, and then at that point we might not get the ideal entry at the highest price. It's always a trade-off. So you got to decide between better entry or some more clues of resistance first. In any case, a break above 1.2650 would probably give this bearish outlook some trouble. I would stay away from the bearish outlook for a little bit if price actually breaks above 1.2650. So let's say we have a stop at 1.2670. That's 20 pips of space there, elbow room there. So that would be a 70 pip risk if the entry is at 1.26. Okay, and at that point, we're still bearish. We can still expect the market to come down to these lows. But if we're going to be conservative, we can say our first target would be this 1.2450 area. Okay, some common lows here. So 1.2450, that's 150 pips. That's still better than that's still a 2-to-1 reward to risk. And then if you look at 1.2370, it's let me see if my math is 1.2370 from 1.26. That's what, like 230 pips to 70 pips. So a little better than 3-to-1. So the euro dollar, we still have plenty of, in my opinion, still have plenty of trade opportunities if the market rallies, and considering the prevailing trend is intact, considering the fundamental factors. And if we're going to look at some long-term target, we can see that in the daily chart, in the weekly chart, we can see further room here to fall until 1.2286, 1.23 area, down to the 2012 low here at 1.2042. But we're not even considering those targets yet when we're talking about these trades in the 4-hour chart. We're only, we're not being greedy here. We're looking for the market to get back to these lows, not even crack it, and we still have pretty good reward to risk. Okay, so we missed this trade here. If the market comes back up, now if the market comes back up, I think we still have another chance around 1.2480. We might not be able to expect, if we're going to short this, then we are assuming that the bearish attempt has already started. That means we can't really expect the market to come all the way back up to 1.25 for us to come back into this trade. So, we're going to lose a little bit in terms of risking a little more because our entry will be a little bit lower. So let's say like 1.2470 area. If we put our stop above at 1.2540, that's 70 pips, and then down to 1.24. It's a 1-to-1 now. It's it's lower than 2-to-1. It's not as attractive, but again, you have to consider the fact that we have a prevailing downtrend, and the potential reward is actually legitimate. You can't expect further downside. Okay, so that's the euro dollar, which actually sets up the template for other US dollar crosses this week. Okay, but I'm more bearish on the euro dollar, for example, than the pound dollar. Um, but I think we can still consider the pound dollar as a candidate to short the rally. And we are already seeing some topping here after a brief bullish correction, right? We topped off at 1.5917. It looks like we have, if we go to the 15-minute chart, you can see this sort of double top, and then you can see this break lower. And now we have a possible bearish continuation attempt, but hey, we can expect maybe in some near-term bounce, in which case we can get in again. Now, this would be a very near-term trade that we're going to talk about here. Let's say around 1.59 ideally, but probably closer to 1.5890 area. Okay, so here we're going to, with this top, we're going to assume that the market has put in a price top, but it might not be ready to go all the way down back to 1.58, for example. And we have to, we have to also consider the fact that these couple of days might be light in terms of fundamentals. That doesn't always translate to low volatility, but tomorrow's Veterans Day, bank holiday in the U.S. We don't have that many significant economic data coming out. So even if it drifts lower, we might not expect it to break below the current low, and we might expect it to find support around 1.5820. Okay, so we already set up our target at 1.5820. Our stop would be above 1.2920, so maybe 1.2930. Okay, maybe even less than that. This is a near-term trade, so we don't want to put a wide stop. If the stop is hit, just stay on the sideline. We might get another sell signal at a higher price, but we don't want to give it too much elbow space for near-term trades. So anyway, let's say 1.5930. Let's say we get in 1.5890. That's 40 pips. 1.5890 down to 1.5820 is about 70 pips. So it's almost 2-to-1 reward to risk. If we're going to trade, probably within the next couple hours, if we have some kind of pullback, come back up to 1.5890, we can consider shorting. Now, it matters, if the market surges, we want to see some small candles kind of drift up towards 1.59, 5890, 1.59 area. Then that would be the ideal case to short it. But if we get an hourly candle that pretty much matches this previous hourly candle, I would stay away from it because we might have some further upside and we might get another sell signal later. Okay, but okay, so that's that. Pound dollar in the next couple of hours, we might have the price at a level where we can sell for around a 2-to-1 reward to risk into the downtrend. In terms of fundamental factors, we already know the FOMC is planning to raise rates mid 2015. The Bank of England, a few months ago actually considered raising rates at the end of this year. So it was going to be earlier than the FOMC, but now it's very uncertain due to the slowdown in Europe. In the latest last week, in the latest Bank of England decision and statement, it noted that it really doesn't want to raise. It basically doesn't want to raise rates at the moment. One, because of wage growth. Wage growth is not there, and we'll see more assessment of inflation this week from the Bank of England. So we'll get that part. But the other part is Europe's slowdown, which is affecting the UK economy as well. So we're probably not gonna see a rate hike until mid 2015, I've seen projections of late 2015 to about probably second quarter of 2015. So we don't have very clear forward guidance at the moment, but it it is apparent that the Bank of England has stepped back a little bit and become more dovish, while the FOMC still seems to be on pace. Okay, even though last week we had disappointing non-farm payroll, disappointing in terms of the forecast, but really in terms of a trend, it is still reflective of a labor market recovery. But again, in the US, it's not about jobs, like number of jobs anymore. Um, it's about wage growth. Okay, so let's move on to the dollar yen, which is running away at the moment. But today we had a good. This was good. This was a good setup here. A few hours in though, so you might have missed it. But so last week, like I said, the non-farm payroll disappointed forecast, but still, it's decent. Um, Now that dollar yen fell from 115.50, drifted a little bit lower to 114, which was this previous support pivot. You saw the RSI tag 30 in the 1 hour chart, so it was a bit oversold at that moment. And you saw the market round out this bottom, and then you saw this bullish candle here, which was the initial bullish signal. Okay, so basically a drift lower. It wasn't a crash, so it was a drift. You see the bears being tentative. You see the bears. Basically, there was a battle here at 114, and then you see bulls win the victory. And this next candle was a confirmation candle, which could also be an entry candle. You see this bullish signal, and then you wait for the price to come back down a little bit to buy. And that's what this candle represented. That's what this candle represented in terms of what the market was doing, right? It came back down, tested some of these previous lows here, intra-session lows, and then popped up. Now it looks poised for the bullish continuation, but again, we know that we could be looking at some low volatility or at least some sideways action without any significant economic releases. So the bullish outlook right now might be limited to 115.50. All right, and now we're pretty much back to the middle of the range, so we don't want to buy there. If the market comes back towards 114.20, maybe we can again consider the buy. But I would still refrain from that because this might be just part of this rally here that hasn't really liberated from the bearish correction scenario. What I'm saying is if this rally breaks above 115 and the 1 hour RSI breaks above 60, there's a good chance that bulls are back in charge. At the moment, it's not clear. We still could have further consolidation. We could still have further bearish correction if price stays below 15. If the RSI doesn't break above 60 and turns lower, then we might want to look for the next support level to consider buying from. Okay, so if we're gonna expect some ABC type of correction back to 113.15. Let's set up a trade here. Let's set up a possible trade. We're looking at some possible support here, really between 112.87 or 112.85 to 113.15 area. So 113 would be our ideal entry. Let's say we get. I'm pessimistic. Let's say we don't really get an ideal entry. We get like 113.20 or something like that. Okay, 113.30 even. Okay. when we set up trades, we can't expect the ideal scenario all the time. So we got to give ourselves um, prepare for less attractive scenarios, and if those still appeal in terms of reward to risk, then the trade might be worth considering. Because if you plan for a trade and you plan for these perfect scenarios and they don't happen and you're not prepared for them, you could really botch up the trade in terms of trade management when you start dealing with things that you weren't prepared for. So always be prepared. That's the bottom line. So let's see, 113.30. If our stop is at 112.70, that's 60 pips, right? In terms of bullish outlook, we have two targets in the short term, 115, 115.50, and these targets aren't even considering a breakout. Okay, so to 115, now 113.30 to 115 is 170 pips. So 170 to 60 is almost 3 to 1, and the target of going up to 115.50 is about uh, 3 to no 200. Let's see, about 220 pips and 60 pips of risk. So about 3.5 to 1. I'm not being precise at the moment. Just had the round like a ballpark reward to risk, and the ballpark reward to risk says that's a it's a attractive enough trade, even without a breakout, even without a bullish breakout. Okay. The long term, when we look at these short term trades, and if the market it does satisfy our target, we just want to make sure we lock in some profit. And if we feel that we want to keep riding the uptrend, which is completely reasonable, the prevailing trend is bullish, and there's no sign that it's reversing. So no, the only thing is people are saying, oh, dollar is overbought. Okay, and we know that in the trend, the currency can be overbought or oversold for quite a period. So just being overbought is not enough a reason to short the dollar. All right. You want to see some, you could get lucky. Someone's going to get lucky shorting the dollar at one point. You get 100,000 people doing something, someone's going to get lucky, but we're not, we want to prepare for not those exceptional cases, but we want to prepare for most likely cases, which is a bullish continuation. So if the market continues, maybe we, scale out to a partial position and see if the market can continue above 115.50. And let's go to the monthly chart. We have to go to the monthly chart to see where we might expect the next resistance. I would say, in the 119, 120 area, we could start expecting some resistance. Okay. All the way up to this 124.16. Wow. So even here, as we get to some common highs in this area from 2016 to 2017, we can expect some resistance in 119, 120. Okay. All right, so that's the dollar yen. What else do we want to look at? And by the way, you guys, if you have any pairs you want to look at, let me know. Again, the Aussie dollar, it's going to look very similar. Okay. Now we did have a break above this falling speed line. Let me back up a little more. Let's back up into October when we had this consolidation, and we saw a similar consolidation in the euro dollar and even in the pound dollar, in terms of the length. It took a month. Okay. And at the end of the month, we had the FOMC, we had the RBA really didn't say much. So this is mostly the story of U.S. dollar strength. and it was able to bring the Aussie dollar to new fresh lows on the year here. All right, so fresh lows, and then we have a rebound that broke above this falling speed line. Okay, now if your U.S. dollar, if your dollar's strong, and the Aussie dollar, I think because commodity prices are pressured, because prices are pressured, the Aussie dollar and the Kiwi dollar are also pressured. Okay, so here in the Aussie dollar we have a pullback, and I was gonna look for probably going back to 0.87 to short, but this pullback found resistance below that. So if we go to the 1 hour chart, we did see a few hours of resistance right here at 0.8680. And okay, so at this point, my trade setup, which already triggered now, was that if the market breaks below 0.8655, it would put in a price top. And then what we want to do is wait for a little bit of a pullback. And if the pullback comes back to 0.8660, it would be, we can consider it shorting. If we do that, we have to put a stop right here about 0.8690, just above this price top. So 8690, 8660, that's 30 pips of risk. And if we're going to look for bearish outlook, considering that we're probably not going to get any significant fundamental factors in the next couple of days, we would limit the bearish outlook to maybe 0.8570. Okay, so that would be about 90 pips. Right, 90 to 30 is 3 to 1, and that would be the trade setup. Okay, so now again, maybe this breakout was too quick. Going back to 15-minute, let's go to the 15-minute chart. Now, when we look at 1 hour setups, we can also look at 15-minute chart for that for the entry, for the trigger. Okay, so we had this break. See, we had the break and the pullback in the same 15 minutes. So it's tough, but I think this next candle after the pullback was a good indication that the market was ready to continue lower in the near term, at least. Okay, now in the near term, in this 15-minute chart, we might get a little bit oversold in the near term and come back to this low on the session, and we could get a little pullback. At that point, again, we can consider shorting. Okay, and I think 0.8655 area, 0.8650, yeah, let's say 55 area. That could be a nice entry spot for a near-term sell. Okay, and in the near-term sell, we can give it some elbow space back up to here. I think the reward to risk is decent enough to give it some elbow space. So let's say 0.8650, and then the stop is 0.8690. That's 40 pips. 0.8650 down to 0.8570 is 80 pips, right? I hope my math is on point today. But basically, it's still 2 to 1. So it's still an attractive trade in terms of reward to risk and in terms of following the prevailing trend. Okay, so that's the Aussie dollar. All right. We have a request for the euro yen. Euro yen is interesting. That as bearish as the euro is, the yen might actually be even more bearish, right? At least when you look at the fundamental factors, when you look at, see, for me, the critical fundamental factor always comes down to the central bank and interest rate. it doesn't, sometimes we shift a little bit of focus here and there, but it always comes back to the central bank and policy decisions affecting interest rates, it affects liquidity, affects money supply. When the Bank of Japan is doing, as the Bank of Japan is doing its qualitative easing, it's trying to pump up the money supply. It, there's no subtlety in that. It's straight up trying to pump up money supply, and the direct effect is a weaker yen. Okay, so there's not much analysis that needs to even go into that. It's pretty much economics 101 there. Um, Now, the euro yen, therefore, to me is going to be neutral bullish. Okay, it might be neutral because the euro the we still don't know what the Euro the European Central Bank is going to do. We know what the Bank of Japan just did, even though it's a surprise. We are pricing that in, and eventually it's going to be priced in. But we don't know if we're going to price in real. The market isn't pricing in QE full steam just yet. So there is still some pull on the euro that might keep the euro yen neutral instead of bullish. Okay, so I would be, neutral, slightly bullish on the euro yen. Now, that's the backdrop. Okay. So let's take a look at the 1 hour chart. I want to start with the daily chart actually, and show that 2014 has been a sideways market. Okay. It has been bullish since 2012. The yen has been weak. So this is really a Japanese yen story. And this latest rally here is also a Japanese yen story. Okay. So being neutral bullish, we can see that there is still some upside risk back towards the 2014 high here at 145.70. In a neutral bullish mode, I would and I would consider buying on a dip. So let's go down to the 4 hour chart, maybe even the 1 hour chart, and we do have a dip. We have a dip from 144.20 down to 142. And so far we are finding support there. Okay. So one trade idea would be to trade this 142 support. You might have to give it some elbow space. Okay. Now look, when we look at the RSI, it's still mostly staying above 40 in the 1 hour chart, which shows that the momentum is still maintained. Although it's not very persistent anymore. When the RSI is able to tag above 70, in this case it's actually tagged 90, which is an extremely bullish sign. Okay. After that, if it could stay above 40, it shows persistence of the bullish momentum. In this case, it's trying to maintain that bullish momentum. Now, if price comes back close to 142, I might consider buying. Okay, only if the price action doesn't accelerate down. If it comes down, decelerates, we find support. Go down to the 15-minute chart. If we see some evidence of buying, get in. So let's say the entry might be like 142.20. Okay. Now, in a very short-term trade, from 142.20, we might set up a stop just below 142. Let's say 141.90. So that would be a 30 pip risk. And our first target in this near-term trade, even though we are bullish, neutral bullish, we still have to consider this 143 area as possible resistance in the short term. What if the market continues to go sideways? Okay, so we might want to take some profit there if it reaches. Now the reward to risk So to 143 would be 70 pips potential reward, right? And the risk was what? Was like 40? Yeah, something. So it's a little bit lower than 2 to 1 if you try to buy on this range low with a target to 143. Now, the target to 144 obviously gives you a much better reward to risk ratio. But again, we always want to be prepared for the less ideal situation, although we don't want to choke out the ideal situation. So we something in the middle there, right? We might want to lock in some profit, but maybe let half a position run towards 144 to give us so we can capitalize if the market does extend a little higher. All right, so that's a short-term trade. Again, the short-term trade is based on this long-term bullish momentum, although it has stalled. Okay, euro isn't as strong as it was in 2013, but the yen is just so weak that we can still consider buying on a dip in the euro yen. All right. All right, so did want to take a look at euro pound because I was looking at that earlier today, and there we go. Okay, we have range play continues in the euro pound. Okay, so since the beginning of the month, the euro pound found support at 0.78 or near 0.78, came back up to 0.7863, and has been consolidating between in this range since. Last week we had the Bank of England. If you take a look here in the middle of the chart, we had the Bank of England followed by the European Central Bank. I talked about how the Bank of England is pushing back its rate hike, doesn't have a clear forward guidance, and is reliant or is impeded by Europe's slowdown in considering a rate hike. So the Bank of England is slightly more dovish than it has been in the past few months, but the ECB is even more dovish. Um, it didn't talk about yes, we're gonna do QE, but the signs are there. It says it's ready to act. It's not worried about its balance sheet. When asked questions about the balance sheet, Draghi was simply saying it's going to expand. It's going to expand in the coming months. There's no target. Okay, so it seems like the ECB is indeed gearing up for QE. It's serious about getting ready for it. It's not just on the table. It's almost like finger on the trigger. Okay, so we'll see. So basically, that reaction was to me appropriate in terms of the ECB being dovish. But again, like I said, the market isn't pricing in QE full steam. If it did, it would collapse under 0.78. Instead, the euro pound found some resilience at 0.78. That's very interesting. And if this translates into a break above 0.7865, then we have a price bottom to start the month. But as we start this week, we saw that price held below 0.7860 and retreated. Okay, so at this point earlier in the day, we taught, it's a little late again. It's a little bit late now, a few hours into the possible trade setup. But this could be a template for other trades, right? You have fundamental factors, you have a prevailing trend. When you look at the daily chart, you have the prevailing trend being bearish. It was a little bit choppy recently, but it is still bearish. Okay, so you have these fundamentals, you have the prevailing trend, and then you have price at key resistance. These three things kind of combine to give you a bearish trade idea. Okay, and then you just got to pick your spots. You got to pick the execute. And if we look at this range, we see this is the top part of the range, the bottom part of the range. We don't want to trade in the middle part of the range if we are trading within the range, right? We either want to trade we either want to trade at resistance or trade at support. In this case, the prevailing trend is bearish, so we would prefer to trade at resistance. Okay. 0.7860, 0.7855. Let's say 0.7855 is the entry. If we have a stop just above this resistance, it would be about 0.7870, which would be about a 15 pip risk. In terms of reward, we're not even looking to continue the prevailing trend. We're just looking for the market to come back down towards the bottom, maybe not even towards 0.78, let's say 0.7810, a more common low here, more like 12. Okay, let's not be let's just get a ballpark number at the moment, point 7850 to 7812, that would be about 40 pips. Okay, even if it's 30 pips, let's say it's 30 pips, and we don't get the ideal entry, and our exit is not, and we have to exit a little sooner, let's say 7815. Okay, so that would be about a 2-to-1 reward to risk if you're able to get in at 0.7855 area. All right. Now, if the market breaks above 0.7865, what do we do? I wouldn't want to buy at that moment. I would want to buy on a dip, if at all. Once again, the prevailing trend is bullish. I'm sorry, prevailing trend is bearish. So any bullish outlook, I would want to be conservative on it, and also I would want to put a little more effort into getting a better price. There's always that trade-off, better price. If you look for the better price, you might not get it. But in this case, if we're going to buy it, we would want to see the market come back down first, in my opinion, back towards 0.78, 45, 50 area before buying. And I would limit that bullish outlook to 0.79, 7905. Okay, so that would be about a 50 pip potential. But if the price breaks below 0.7830, I would want to get out. So that's about again, it would be about a 2-to-1 if we actually get an ideal price entry. And like I said, sometimes you don't get the ideal entry and you still go with it. This one I would prefer to stay away unless the entry is closer to 0.7840. Again, we're talking about a bullish breakout and then a pullback. Okay. All right. And when the third trade idea is, okay, we're not going to trade this bullish bullish correction scenario, but if it does occur and price comes back to 79, we can consider selling there again with a stop just above this 0.7910 area. So let's say 0.7930. Okay, that would be a 30-40 pip risk. Okay, and if our bearish outlook, our first bearish outlook should be back towards the middle of this, which is around 0.7830, 7840. So that's about 60 pips. Okay, so it's going to be a little less than 2-to-1 realistically, but this is a conservative target. If the target is back towards 0.7810, we get a little better than 2-to-1 reward to risk from a trading from 0.7890, 0.79 area. All right, so let's see, what else do we want to look at? Maybe we should look at gold. Okay, it's been in an interesting development. And I want to start with the weekly chart in gold because it just broke below a 2013-2014 consolidation, which could be seen as a descending triangle. Okay, so after this bearish swing, we had a consolidation, and now we have a bearish breakout, which signals bearish continuation in the medium to long term. And we're talking about outlook into 2015. Okay, and just looking at some levels here, we sort of have a pivot here around, oh, what is that? Around, 1030, 1040. Even I would think the 100 handle, well, 1000 handle psychological level would be the next key support, even though we do see some support pivots above that. All right, there we go. All right, so here's some, we're looking at some further room to fall here. Okay, in the short term, this 1100 could be our short-term target. There's some common support levels here, but we should considering the bearish trend here, we do have downside risk towards 1000. Now, looking back into the short term, we have this bullish attempt, which comes back to the old 1180 was the triangle support, the broken triangle support that we saw in the weekly chart. In the weekly chart, the breakout isn't very convincing, but as we look in the daily chart, we do see the breakout being pretty sharp here. Now, when we look at the 4-hour chart, we saw the breakout below 1180, and this was pretty sharp. Now, when when the market came back and approached 1180, I was looking at 1180 to 1200 as this wide area of possible sellers. Okay, and at the moment we already have a dip here from 1180. I would limit this bearish outlook for in the next couple of sessions again because of low volatility, but I think it's ready for the bearish continuation. What I like to see is some consolidation sideways. Okay, right now I feel like it's ready for bearish continuation, but there's also some upside bullish correction risk towards 1200. Now, if it goes to 1200, I would be more inclined to short without seeing the consolidation first. But I would, as long as price action isn't accelerating towards 1200, if it comes up and drifts, I would look at 1200 as an area to sell. Okay. Now looking at this 4-hour chart, let's put in some. Okay, so 1200. If it breaks above 12. If it breaks above 1220, 1225, this bearish continuation outlook might be in trouble. We might be in more of a consolidation. To be honest, at that point, I would step away and look for more clues. I can't tell you now what my outlook would be if that were to happen. But I would say that at that point, the bearish outlook would look a little bit, like it's struggling. So if we're going to sell around 1200, let's say 1190 and put a stop above, stop at 1225, 1230, that's 40 units. That's a lot, 40 units for a short-term trade. So 40 units, but to the downside, remember we talked about the 1100 target. a conservative target down to 1140 would be a 50 units. So it's barely 1-to-1, right? I mean, it is a little bit better than 1-to-1, right? If you get an 1190 and your stop is at 1230. That seems like a wide stop. I mean, I would consider a little tighter stop, and then if it hits that stop, I would maybe plan another trade at a higher price. Um, but there's always trade-off between breaking between looking for another trade, in which case it seems like you're chasing the trade, and you don't want to get into the habit of that. It's psychologically it's tough on you, but at the same time, having a wide stop is also psychologically tough. So trading's never easy. It's always a thing of trade-offs. You're always, your winnings are always at the margin. It's never because of one trade that you are a winner. Although there are periods in the year where you might be able to make all your winnings, and then the rest of the year you might be drifting. You never know. But the plan is to try to trade without that much, for me at least. For me, my trading style or comfort level is that I don't like these wide drawdowns and large um, gains. I like to trade at the margin. And so I'm told here that we are going to have to wrap up. We still have a few minutes. So if you have any questions, I'm going to be here for a few more minutes. Otherwise, I just want to wish you guys, safe trading, most importantly, and good trading. All right. Once again, check me out at www.forexminute.com. I'll be posting some updates on these majors throughout the week. So hope you guys drop a comment here and there, and trade well, trade safe. Bye.